If you have a tax-free savings account in Canada, what is about to happen in 2026 could quietly erase years of smart saving. Most people with a TFSA have no idea that major changes are coming. They will find out when it is already too late, when penalties have already been applied, when contribution room has already been lost, when the government has already sent the letter. You do not want to be that person. Right now, the rules around TFSA contribution limits, overcontribution penalties, and residency requirements are shifting in ways that have never happened before. The Canada Revenue Agency is tightening enforcement. The contribution room calculation is becoming more complex. The definition of what counts as a contribution is being refined. And the consequences for getting it wrong are not small warnings. They are financial hits that can cost you thousands of dollars, sometimes without you even realizing what went wrong. This is not fear-mongering. This is the reality that thousands of Canadians are going to face in 2026 and beyond. And the reason most of them will be caught off guard is simple. Nobody talks about this until it is too late. The information is available, but it is buried in technical documents that most people never read. The changes feel distant until they suddenly are not. And by the time the average TFSA holder realizes what happened, the damage is done. So let us walk through exactly what is changing, what it means for you, and most importantly, what you need to do right now to protect yourself and your family. Here's the first thing you need to understand. Your TFSA contribution room is not just a number sitting in an account. It is a living number that changes every year based on your residency status, your age, and rules that have been in place since the TFSA was introduced in 2009. The government tracks your room carefully, and they expect you to track it too. Most people assume that if they stay under the limit, they are fine. But that assumption is exactly where the danger lives. The problem is that contribution room is not just about what you put in. It is about what the government believes you are eligible to contribute. And that depends on whether you were a resident of Canada for every year since 2009, whether you were a non-resident at any point during those years, and whether any of your contributions came from sources that do not actually count as contributions under the refined rules. These are not hypothetical concerns. These are the exact details that are being audited more frequently and more aggressively starting in 2026. Most people who end up with TFSA problems do not think of themselves as rule breakers. They consider themselves ordinary savers. They put money aside for their kids, for emergencies, for retirement. They thought they were doing everything right. And then one day, they get a letter from the Canada Revenue Agency telling them they have been over their contribution limit for months, sometimes years, and they owe a penalty that feels completely unfair given their intentions. That penalty is 1% of the excess amount in your account. For every single month, it stays there. On a $10,000 overcontribution, that adds up to $100 every single month. Over 12 months, that is $1,200 gone just from a simple mistake that felt like nothing at the time. What makes this especially painful is that most overcontribution situations do not come from greed or from trying to cheat the system. They come from confusion. People have multiple TFSA accounts across different institutions. They do not realize that contribution room is calculated across all of those accounts combined. They switch banks and open a new TFSA without understanding that the room from their old account does not magically reset. They inherit a TFSA and do not realize that the contribution room rules work differently for inherited accounts. Each one of these situations seems minor on its own, but put together, they create a scenario where an innocent person ends up with a penalty bill they never expected. If you are watching this and you have a TFSA, I want you to ask yourself one question right now. Do you actually know your exact TFSA contribution room for 2025 and 2026? Not an estimate, not a rough idea. The exact number? If the answer is no, you are already at risk. And that is not an exaggeration. Here's what nobody tells you about TFSA contribution room. It is not just about how much you deposit. It is about how much you were allowed to deposit, which is tied to your status as a Canadian resident. If you were living outside Canada for part of the year, your contribution room for those years may be reduced or eliminated entirely. And if you contributed to a TFSA while you were technically a non-resident, those contributions may not have counted the way you thought they did. The rules around residency and TFSA eligibility are precise, and they are strictly enforced, but they are almost never explained in plain language anywhere that regular people actually look. This is where it gets serious. The Canada Revenue Agency has been building more sophisticated systems to cross-reference TFSA contributions with residency records, with income data, and with information from financial institutions. What this means in practical terms is that gaps and inconsistencies that used to slip through the cracks are now being caught. The systems are smarter, the enforcement is more consistent, and the penalty structure has not gotten any softer. If anything, the CRA has been increasing the resources dedicated to TFSA compliance audits because the amount of money involved has grown significantly as TFSAs have become a mainstream savings vehicle for millions of Canadians. You might be thinking, I have been fine so far. Nothing has happened. And that may be true. But 2026 is a threshold year for a specific reason that most people are completely unaware of. Several technical amendments to the Income Tax Act that have been in the works for years are coming into full effect. Changes related to how TFSA contribution room is calculated for individuals who have complex residency histories. Changes to how the CRA interprets contributions made through certain types of accounts, and updated guidelines for financial institutions on how they report TFSA activity are all converging in 2026. The result is that what used to be acceptable may no longer be acceptable. What used to be interpreted one way may now be interpreted differently. And the people who do not know about these changes are the ones who will pay for them. Let me give you a real example of what this looks like in practice. Imagine someone named Jordan. Jordan opened a TFSA in 2015 and contributed $5,000. Over the next few years, Jordan traveled extensively for work and spent time living in another country. During one of those years abroad, Jordan received a windfall from a family member and decided to contribute another $3,000 to the TFSA. Jordan thought this was fine because the account was still open and the total contribution was still under the maximum limit for that year. But here is what Jordan did not realize. Because Jordan was technically a non-resident of Canada for part of that year, the contribution room that year was either reduced or did not exist at all, depending on the exact dates. The $3,000 contribution may have created an overcontribution situation, even though it looked fine on the surface. Now fast forward to 2026. The CRA is running a routine compliance check, cross-references the residency records, and identifies the overcontribution. The penalty is assessed retroactively. Jordan receives a letter and a bill for thousands of dollars in accumulated penalties. Jordan is shocked and upset, but the rules do not care about Jordan's intentions. The rules care about the numbers. This exact scenario is happening to real people right now, and it is going to happen to many more people in 2026 unless they take action before it is too late. The good news is that in most of these situations, there are steps you can take to correct the problem, reduce the penalty, or avoid it entirely. But those steps only work if you take them before the CRA sends the letter, not after. Once the penalty assessment is in place, your options become more limited and more expensive. Before we go further, if this information feels relevant to your situation, make sure you keep watching. The most important part of this video is coming up next, and it could make the difference between protecting your savings and losing thousands of dollars you worked hard to earn. The most important action you can take right now is simple. Find out your exact TFSA contribution room for every year going back to 2009. Do not rely on your memory. Do not rely on what your bank told you. Pull your official notice of assessment from the CRA. Check your TFSA contribution room statement through your CRA My Account portal and verify every single contribution you have made across every single TFSA you hold. Yes, this takes some time, but it is nothing compared to the time, stress, and money you will spend dealing with a penalty assessment that could have been prevented. While you are doing this, look carefully at any years where your residency status may have changed. If you left Canada for more than a few months, if you became a non-resident for tax purposes, if you returned to Canada after living abroad, those transition years need special attention. The rules are more complicated in those years, and the margin for error is much smaller. If you are not completely certain about how the rules apply to your specific situation, this is one of those moments where a single conversation with a qualified tax professional could save you a five-figure penalty. That is not an exaggeration. Overcontribution penalties can accumulate for years, and on large balances, the total can be enormous. Another thing you need to understand is that the financial institutions where you hold TFSAs are also being asked to be more precise in how they report contributions and track limits. Some institutions have been doing this better than others. Some have been allowing contributions that were technically over the limit because their internal systems were not catching the full picture across all accounts. Starting in 2026, that inconsistency is going to create problems for customers who were never told their contributions were exceeding the limit until the CRA catches it later. This means you cannot fully rely on your bank to tell you when you are in trouble. You have to take responsibility for your own contribution room tracking. It is simply too important to leave to anyone else. Here's another angle that most people never consider. What happens to your TFSA when you die? Most people think it just goes to your beneficiary or your estate and everything is straightforward. But the rules around inherited TFSAs have their own complications, and some of the changes coming in 2026 will affect how those inherited accounts are treated. The person who inherits your TFSA may have different rights, different obligations, and different contribution room implications than you expect. If you have a TFSA and you have not thought carefully about what happens to it after you are gone, 2026 is the year to get that sorted out. Beyond the inheritance issue, there is also the growing concern about what happens when people have TFSAs at multiple institutions, and one of those institutions goes through a corporate reorganization, is acquired by another bank, or makes changes to how it reports account information. These corporate events can create discrepancies in your contribution room records that take time to resolve. In the meantime, you could be penalized for contributions that were made in good faith but are now being reported inconsistently across different systems. The solutions to these problems exist, but they require you to be proactive, to keep records, and to act quickly when something does not look right. One more thing you need to understand, and this is something that even people who consider themselves financially sophisticated often miss. The concept of a qualifying withdrawal versus a non-qualifying withdrawal sounds technical, but it has a very real impact on how much contribution room you get back. Most people assume that when you take money out of a TFSA, you get that room back the next year automatically. That is not always true. The rules for when and how your contribution room is restored depend on the specific circumstances of the withdrawal, and in some situations, that room does not come back the way you expect. This creates a scenario where people think they have more room than they actually do. They contribute again thinking they are safe, and they end up over-contributing without realizing it until the CRA sends the notice. Understanding this single detail could be the difference between a clean record and a costly penalty. Here is what most people also do not realize about their financial institution. Banks and investment firms have their own responsibilities when it comes to TFSA compliance, and those responsibilities have been tightening. Starting in 2026, financial institutions are required to apply more rigorous verification processes for TFSA contributions, especially for accounts that show patterns that might indicate overcontribution risk. This sounds like it should be protecting you, and in some ways it does. But it also means that if your account activity looks unusual to their systems, you might find your transactions flagged, delayed, or questioned. This is not necessarily a bad thing, but it can be frustrating if you do not expect it. Knowing that this is coming can help you respond calmly and provide the information needed quickly instead of feeling blindsided. The bigger picture here is that TFSAs have grown into one of the most important savings tools for Canadians. More than 17 million Canadians have TFSA accounts with a total balance that has grown into the hundreds of billions of dollars. That scale means the government has a strong interest in making sure the program stays sustainable and fair. And that means the rules will continue to evolve and the enforcement will continue to become more sophisticated. The people who protect themselves are the ones who stay informed, stay proactive, and do not assume that the rules from 5 or 10 years ago still apply exactly the same way today. This is why I keep emphasizing the same point. The risk is not that the TFSA is suddenly going to become a bad product. It is not. For most people, a TFSA remains one of the best savings vehicles available in Canada. The risk is that you will operate under assumptions that are no longer accurate, and those assumptions will cost you money in penalties, lost contribution room, or both. The gap between what people think the rules are and what the rules actually are is wider than most people realize. And 2026 is the year that gap gets enforced. Think about how it would feel to get a letter from the Canada Revenue Agency saying you owe money because of a TFSA overcontribution you did not even know you had. Think about the stress of trying to fix it after the fact, the time spent dealing with paperwork, the money spent on professional advice, the anxiety of not knowing exactly how much you might owe. Now think about the alternative. 10 minutes today pulling your records, a few hours this week verifying your contribution room, maybe one conversation with a professional if your situation is complicated. That is what separates the people who sail through 2026 without a problem from the people who spend months dealing with the aftermath of a mistake that was entirely preventable. So here are the specific steps you need to take right now. Not next week. Not when you have time. Today. First, log into your CRA My Account portal and pull your official TFSA contribution room statement. This is free, it is official, and it will tell you exactly how much room you have. If you do not have a CRA My Account, set one up immediately. It takes about 15 minutes, and it is the single most important tool you have for managing your TFSA compliance. Second, get a complete list of every TFSA you hold at every institution. Do not leave any out. Joint accounts, TFSAs that were opened and then sat empty, TFSAs that were transferred from one bank to another. All of them count. All of them affect your contribution room. Third, compare the total amount you have contributed across all accounts to the room you have available according to the CRA. If you are over or if you are close to the limit and you are not completely sure, stop contributing immediately and get professional advice before you add another dollar. Fourth, if you have any years in your history where your residency status was complicated, where you lived outside Canada, or where you came and went between countries for work or family reasons, talk to a tax professional who specifically understands TFSA rules for non-residents and returning residents. This is not the kind of situation where a general accountant will give you the right answer. You need someone who knows the specific rules that apply to your circumstances. Fifth, if you have beneficiaries named on your TFSA, or if you have not thought about what happens to the account when you pass away, review your beneficiary designations and your overall estate plan. This is something that should be reviewed every few years anyway, and 2026 is a good year to make sure it is current. And finally, if you have any friends, family members, or colleagues who also have TFSAs and who might benefit from knowing what is coming, share this information with them. Not because you have to, but because you probably care about them, and because they almost certainly do not know what is happening. A 5-minute conversation right now could save someone you care about thousands of dollars and months of stress. The information in this video is not complicated. The rules are technical, but the action steps are simple. Know your number, know your accounts, know your status, and act before someone else acts for you. That is the entire game here. If you found this video useful, that is exactly the reason I made it. If there is a parent, a sibling, a friend, or a colleague who has a TFSA and who might not know what is coming, send this to them. You might be doing them one of the most helpful things anyone can do for a loved one's financial well-being. The TFSA was created to help people build wealth without the tax burden that comes with other types of accounts. That is still what it does. But the rules around it have gotten sharper, and the stakes for getting them wrong have gotten higher. You have the knowledge now. You know what to look for, what to avoid, and what to do. The rest is up to you. Go check your account today, not next week. Not when you have time, today, because the next few months before 2026 arrives are exactly the window where you can still fix problems, prevent penalties, and make sure your contribution room is exactly what you think it is. Do not waste that window. Your future self will be glad you did not.